Alright, y'all, welcome back to my channel. And with y'all back, today I want to go over. I pulled up a couple of articles and I also pulled up a house price from Plano, Texas on Zillow. And we're just going to run through this article and this next article that I got, and we're just going to read through them. And after I'm done kind of reading through them and stuff, I'm going to give y'all kind of what I think, and we'll go from there. So, to sit back, get you some popcorn, get you something to drink, and you're going to listen to a 25-year-old rant over an article somebody wrote on the internet. So let's have some fun with that being said. Okay, so I got pulled up here this article from theherald.net, just a random article. I just literally typed in something about, hey, what's inflation doing? And I found this article. But it's a commentary from a Carl W. Smith, who writes for Bloomberg in their opinions section. So we're going to see what Mr. Carl W. Smith has got to say and kind of give you my own thoughts about it. But he says right here, comment, while longer lasting inflation might be a good thing. Okay. Mr. Carl, let's see what your opinion is. He says, the administration of President Biden has repeatedly assured Americans that the sharp uptick in inflation that they are experiencing is temporary, in the language of economists, transitory. Surveys suggest that the public is less than convinced, but consumer expectations of inflation are notoriously fickle. I'm not claiming I know what fickle means, so we're going to move on. But I kind of get the gist of what he's saying. All of this has economists and central bankers dutifully poring over the data for signs of whether inflation, currently just under 4%, will drift back toward the Fed Reserve's target of 2%. Instead, they should be considering a more fundamental question, whether the Fed should strive to make 4% inflation permanent. Okay, so he's saying instead of making 2% inflation permanent, let's jack it up to 4%. Let's hear your article, or let's hear your opinion and see. To be clear, there is no doubt that the recent rise in price growth has been an unpleasant shock. That's partly because it's so uneven. Prices on commodities such as gasoline, lumber, along with a few select goods such as used cars, have risen by double-digit rates. I'm saving my opinion. A sharp increase in the price of even a small set of products. Oops. Hold on, guys. We got some adjusting to do. Okay. I do apologize for that. Okay. He says, to be clear, there is no doubt that the recent rise in price growth has been an unpleasant shock. That's partly because it is so uneven. Prices for commodities such as gasoline and lumber, along with a few select goods such as used cars, have risen by double-digit rates. A sharp increase in the price of an even small set of products creates far more pain than a rise in the overall rate of inflation, which is averaged across thousands of products. But narrow inflation is also the type of inflation that's most likely to reverse, since it reflects supply chain disruptions that will eventually be relieved. Analysts are concerned that the rise in inflation may be persistent because they see hints of a broader, gentler rise in prices across a range of goods and crucially in wages of workers who produce those goods. Okay? Interesting. Yet this increase in both wages and prices can lead to the dreaded wage price spiral. Because it is shared by both households and businesses, the pain is muted. Indeed, a higher rate of inflation and a correspondingly higher wage growth could be a net positive for the economy. There are two main reasons. The first is debt dynamics. Higher rates of inflation make debt more expensive but easier to manage. A permanent increase in inflation from 2%, its average over the past decade, to 4% would cause interest rates to rise by roughly 2% as well as leaders sought to protect themselves from rising prices. Economists describe this rise in nominal rates because the net return from lending, the real interest rate after accounting for inflation, remains the same. One way to see how this would play out is to consider the mortgage market. Higher nominal interest rates would mean a higher monthly payment for any given loan. That might seem to make houses even less affordable. But what's been clear over the last 2 decades, and what economic theory predicts, is that housing prices in the most desirable urban areas are determined by maximum mortgage of an affluent urban family can afford. Buyers in those markets bid against each other for a relatively fixed stock of housing. Over the last decade, as nominal interest rates fell, families could afford to take out larger mortgages, and so maximum bids rose. Overall, buyers ended up with roughly the same monthly payment. Yet wage growth was also slow over the last decade, so those same families haven't seen their mortgage payments decline as a fraction of their income at the same rates as previous generations did. Okay, interesting point. They have less room to manage unforeseen expenses, making their financial future more uncertain. Modest increases in inflation and wages would reverse this whole process. That is, they would decrease mortgage sizes and maximum bids, thereby slowing the rise in home prices. Meanwhile, rising wages would make those mortgages more affordable over time. The second reason to support inflation and the resulting higher nominal interest rates has less to do with homeowners than the Federal Reserve Chairman Jerome Powell. Higher interest rates would give the Fed more room to cut interest rates in the case of a downturn. When COVID struck, the nominal interest rate the Fed controls was only 2%. That gave it very little room to stimulate the economy. Fortunately, in part because of the unusual nature of the recession, Congress did. Oh, yes, they did. The next recession, hopefully, will not be the result of a global pandemic. That means Congress is unlikely to provide the same level of support, and the Fed will have to do more to stimulate the economy. To do that, it needs higher nominal interest rates. Inflation, particularly when it is caused by sharp increases in a few products, is politically unpopular. I wonder why. Okay, a modest sustained increase in price wages, however, would create a more stable U.S. economy by improving debt dynamics and giving the Fed more flexibility. In an uncertain world, those two advantages make higher inflation more than worth it. Carl W. Smith is a Bloomberg opinion columnist, and he was formerly vice president for federal policy at the Tax Foundation and assistant professor of economics at the University of North Carolina. He is also a co-founder of the economics blog Modeled Behavior. Okay, so we went through the article here, and he's made some interesting points throughout this article. But I do want to address one point that he made, and he's talking about the raising of nominal interest rates, which in normal human speak means the main interest rate that the Fed sets, they set it at 2%, or like this guy's saying, need to be set at 4%. That means that the money that the banking system, when a bank in the banking system goes to the Fed and wants to borrow money from the Fed, they have to pay that interest rate to the Fed. So that's like the floor rate. That's the bottom rate. So what he's saying is he wants to raise the bottom rate higher than it is currently. Well, when you do that, when you raise the floor rate, then all of your consumer loans, business loans, and so forth, excuse me, they have to go up to meet that requirement. Let's say you want to go and get a home loan. Now, with the interest rate at, I don't know what it is. Let's say it's roughly around 2%. Hypothetically, let's say the interest rate at the Fed is 2% right now. Okay? If they raise it to 4%, back when it was 2%, you could get a loan from a bank at like 3%. There's a 1% profit margin for the bank. Okay? Now, when they raise the interest rate to 4%, in order to get that same profit margin, they're going to have to give you the loan for 5%. So it went from a 3% loan to a 5% loan. The bank's end, they're still making the 1% that they were, but on your end, you're going to be paying more. You're going to be paying more out. Instead of 3%, you're going to be paying 5%. So it's going to hurt your pocketbook more if the loan amount that you require is the same loan amount. Now, if you require a smaller loan amount, then maybe things equal out, but that's an unknown. So it's an interesting point. He's saying raise the nominal interest rate, but it has some major repercussions, especially for people that want to take out loans for like a house or a business or a car or whatever. It makes borrowing higher. On the flip side, here's where raising the interest rates is good. Raising the nominal interest rates is a good thing. If you raise the nominal interest rates, the money that you put into the bank in savings in a checking account that actually pays interest, if there's any of those that are left, the money that you do put into the bank will pay you money for keeping the bank more. Instead of getting 2% on your money, or 1%, or like 0.6%, you'll get 4%. Quite a significant difference. So it'll definitely help anybody that's a saver. Let's say they're wanting to save up to buy a car, or they want a fancy new hunting rifle. They can save up for that, and the bank is paying them interest at a higher rate, which helps them to save easier. They're getting a return on their money that they're putting in the bank. So, in that sense, on the surface, it helps. Here's where I'm skeptical. Let's say you go ahead and you raise the nominal rate, but you have all of this inflation that we currently have. I'll rant here in a minute, but you have all of this inflation that keeps jacking prices up and stuff. Let's say the prices for a loaf of bread down at Walmart. They keep sending me this thing. But let's say they send you, or you go to buy a loaf of bread, and they have the nominal interest rate at 2% with all the inflation. Well, you're going to pay $4 for a loaf of bread, higher than you used to. Now they jack up the nominal interest rate, attempting to put a cap on the inflation. Because that's the whole idea. The more you raise the nominal interest rate, it's attempting to put a cap on the inflation, the rise in the value of goods. Well, actually, inflation is the printing of money or currency. But one of the direct cause of the printing of currency is the rise in the value of certain things. The rise in the value of things you would buy. Anyhow, getting back to my point here. If they jump the nominal interest rate up and that doesn't start to counteract the effect of inflation, well, then you've just made everything that, however much more you jacked up the interest rate, you just made it that much more expensive on top of already the inflation. So If it counteracts the inflation, then it's a good thing. But if it doesn't, it's a bad thing. And inflation already eats away at your savings. So if you implement this rise in nominal interest rates and it doesn't slow down inflation, well, then it's just going to eat your money away faster. Now, whether it does that or whether it actually puts a cap on inflation and cools things off, you don't really know. But that could be one of the side effects. So, I mean, kind of take the article as you will, but I thought it was an interesting read. He brings up some decent points, and as you can see, they locked me out, so I can't really read it that much more, which is BS, but whatever. But, I mean, he makes an interesting point. And the main point that I see he's making is, hey, let's raise the interest rates. If we raise the interest rates, one, if we can get inflation under control, it'll help you to save money more because banks will actually pay you to store your money with them. And maybe it'll stop things stop bread from being $10 a loaf. It's a good idea. Maybe we need to try it. He makes some valid points, but I have some questions. Anyhow, I got this second article pulled up here from Reuters. Yeah. Alright, ladies and gentlemen, I do apologize about that, but for the rest of the video, video of me is not going to be in the video because of, well, power issues. But we're going to go ahead and continue, and I'm going to restart over and talk about this second article I got right here from Reuters, and it's by Lucia. Again, I can't pronounce her name. I'm not good with last names, but she's talking about U.S. home prices and kind of how housing prices are going and inflation involved with the housing prices. So let's dig into her article. September 22nd, U.S. home sales fell in August as supply remained tight, but there are signs that the surge in housing prices and the COVID-19 pandemic-fueled demand have probably run their course. Still, prices remain high enough to keep some potential buyers from a hot housing market. The report from the National Association of Realtors on Wednesday showed the smallest share of first-time home buyers in more than 2.5 years, and housing prices continued to be snapped up, typically after only 17 days on the market. That's pretty impressive. The recent moderation in existing home sales reflects some easing of the buying frenzy that carried over into July of 2021, says Mark Vittert, a senior analyst at Wells Fargo in Charlotte, North Carolina. The frantic race for space sent prices soaring. We continue to expect the housing market to move back into a balance over the next couple of years. Existing home sales dropped 2% to a seasonally adjusted annual rate of 5.88 million units last month. Sales fell in all four regions, with the densely populated South posting a 3% decline. Economists polled by Reuters had forecast sales would decline to a rate of 5.89 million units in August. Single-family sales fell 1.9%, while condo co-op sales dropping 2.8%. The decrease in sales coincided with a recent change in consumer attitudes toward buying a home. Home resales, which account for the bulk of U.S. home sales, fell 1.5% on a year-on-year basis. The annual comparison was distorted by the pandemic-driven surge in sales in August 2020. Sales are up 16% so far this year compared to the same period in 2020 and remain well above their pre-pandemic level. The housing market boomed in early boomed early in the coronavirus pandemic amid an exodus from cities as people worked from home and took classes online, which fueled demand for bigger homes in the suburbs and other low density areas. The surge, which has skewed towards the single family housing market segment, far outpaces supply. Expensive building materials as well as land and labor shortages have made it harder for builders to boost production. At the same time, some homeowners are reluctant to sell because of concerns they might not find something affordable, keeping inventory tight. Government data on Tuesday showed single family home building fell for a second straight month in August. Though the pandemic tailwind is fading, demand for housing remains strong thanks to near record low mortgage rates and rising wages from a tightening labor market. A separate report from the Mortgage Bankers Association showed a modest rise in application for loans to purchase a home last week. Mortgage rates could rise after the Federal Reserve on Wednesday cleared the way to reduce its monthly bond purchases soon and signaled interest rate increases may follow more quickly than expected. Stocks on Wall Street were trading higher, recouping some of the recent losses and concerns over the default by the Chinese property developer Evergrande eased. The dollar fell against a basket of currencies. Prices of longer dated U.S. Treasuries rose, tightening supply. The median household price increased 14.9% from a year ago to $356,700 in August. That is a deceleration from a 23.6% jump in May. The slowdown in housing price inflation adds to anecdotal evidence that some sellers are reducing their asking prices. Realtors are also noting that bidding wars are subsiding. We expect home price growth to slow further over the balance of this year through 2020 as the housing inventory shortage eases and demand moderates, said Scott Anderson, chief economist at the Bank of West in San Francisco. Sales remain concentrated in the upper price end of the market, with transactions of homes in the below $250,000 price range continue to experience double-digit declines. Residential investment contracted in the second quarter after three straight quarters of double-digit growth. August sales declined implies lower broker commissions. This, together with the drop in housing starts, suggests a further decrease in residential investment this quarter. There were 1.29 million previously owned homes on the market last month, down 13.4% from a year ago. At August sales pace, it would take 2.6 months to exhaust the current inventory, down from 3 months a year ago. A 6 to 7 month supply is viewed as a healthy balance between supply and demand. In August, properties typically remained on the market for 17 days, unchanged from July, but down from 22 days a year ago. 87% of the homes sold last month were on the market for less than a month. First-time home buyers accounted for 29% of sales, the lowest since January 2019, and down from 30% in July and 33% a year ago. All cash sales accounted for 22% of transactions, down from 23% in July and up from 18% a year ago. There is a suggestion here in the moderation of price gains in sales and a declining share of first-time home buyers that a considerable portion of the stock adjustment of demand for homes to lower rates and pandemic-driven population moves has taken place, said Conrad De La Cuadros, senior economic advisor at Bain Capital in New York. Okay, so the gist that I'm getting from this article is basically that they're saying housing prices, they're not saying housing prices are coming down at all. What they're saying is the rate at which housing prices increased is not going up as severe as it was. But still, I mean, when you got wages, that I guarantee you are not increasing at a 14.9% rate. Let's say your wage increase per year, if you're lucky, let's say is 4 or 5%, which it ain't. No company is going to increase their wages by 4 or 5% a year if they can get out of it, unless it's in a really high demand deal. But they're not going to do that if they can get out of it. And then you've got housing prices increasing by at least 14.9% a year. I mean, I hate to be the bearer of bad news, but it doesn't matter if it's going up by 14.9% if you're only making an extra 3% to 5% a year because your boss only gives you a 3 to 5% raise a year. That's if your boss even gives you a raise and can afford to do so in the first place. So I would say one thing that they're missing in this article is the fact that the reason why growth is starting to slow off, like the price increases are slowing off, is because everybody that's in the middle class and lower class can't afford to buy anything. Everything is done jumped up so high, you've done run them out of the market. They can't buy anything. And I'll demonstrate this when we pop over to Zillow. So when you run everybody out of the markets completely because prices have run up so high, you've basically relegated them to renting an apartment or a house, renting, and waiting for basically housing prices to actually come down instead of increasing at a slower rate. Eventually, they're priced out of the market, period. And all you're left is with people that's got the assets and stuff to be able to afford them in the first place. With You're talking about people that got millions and millions of dollars, they can afford that. But your average person can't afford stuff when inflation in housing, which is one of the essentials, is going up roughly 14% a year. Now it is slowing down, but still, it's not slowing down that much, and your wages ain't jumping that much to compensate. So this just goes back into kind of my rant going into the other article is the inflation is higher than your wage growth, and your inflation is eating at your savings while everything costs more. So the yin yang ain't yin yanging too much, or at least that's what it seems like. But let's take a look over here at this Zillow property when I can get it actually pulled up. I'm sorry, y'all. My internet is not doing too hot. Well, unfortunately, the internet's not doing too hot. So, with that being said, y'all, here's these two articles. I just kind of wanted to go over them, read them to y'all, and kind of give y'all a little bit of my thoughts on it. And I want to hear y'all's thoughts in the comment section, so let me know. And with that being said, I will get out of here. Y'all have